Good morning, trader friends. Today, Friar is addressing what he believes is a confirmed macro regime shift, a simultaneous convergence of three independent shock variables that collectively signal a transition from mixed signal environment of recent weeks into a structurally bear setting. Friar will be precise about what has changed. We are not reacting to a single data point. Three entirely separate systems, fixed income markets, energy markets, and the geopolitical architecture have moved decisively and in the same direction within a 48-hour window. Firstly, 30-year US Treasury yield has reached 5.12. The highest since May 2025, approaching highs not seen since October 23, following the COVID lies. Also, the 10-year US Treasury yield is now 4.595, a 14 basis point single-day surge. West Texas Crude above 105, Brent above 108. I'm making this on Monday morning, Thai time, and WTI is now 107.7 and Brent 111.3 and on the rise. So Hormuz closure is deepening. IEA warns of undersupply through October, assuming that the strait opens today. It's not opening today. Let's say the word not. Trump-Xi Beijing summit produced no substantive agreements. Taiwan threat escalated. Hormuz relief pathway narrowed. The task Friar's looking at is, will these three independent data points, how will that affect the institutional trading bots? Three simultaneous shocks. This slide frames the structural architecture of today's analysis. The critical insight is the fact that these are happening simultaneously. Any one of these three shocks in isolation would be noteworthy. All three occurring within a 48-hour window constitutes a multivariate regime signal. In academic terms, this is precisely the type of event described by Brunemeyer and Pedersen in their 2009 Journal of Finance paper, Market Liquidity and Funding Liquidity, when multiple independent risk parameters breach their institutional thresholds simultaneously, correlated de-risking follows mechanically. Not because the portfolio managers have decided the world is bearish, but because their risk models compel position reduction. Bond shock. Yields surge driven by messy inflation data and a new Fed chair Warsh's complicated mandate. Energy shock. Hormuz closure deepening. Diplomatic efforts stalling. IEA confirming structural undersupply. Geopolitical shock. Beijing summit produced no agreements. China-Iran leverage dynamic now explicit. And I'll add to that the UAE's power structure being hit during the weekend with drones, assumingly from Iran. The bond market move on Friday the 16th, 26, was not incidental. It was the market pricing in what Wolf Street called the second wave of inflation, and crucially doing so under the stewardship of a brand new Federal Reserve Chair whose policy preferences are not yet fully legible to the markets. Kevin Warsh was confirmed by the Senate only last Wednesday. He inherits an inflation picture that remains structurally problematic, energy costs rising from Hormuz, food prices about to follow, and wage pressures still embedded. Markets are asking a simple question: will war cut into this? The answer, priced into the long end of the curve, appears to be not soon. The 30-year bond at 5.121 is 11 basis points increased 11 basis points in a single session. This is the bond market's version of a fire alarm. Beep, 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 beep. 10-year bond at 4.595, the benchmark borrowing rate, mortgage rates, corporate credit, equity discount rates all follow. The AI boom is based on borrowings. The yield curve is now humping in the 2 to 5 year range, a structural configuration that historically precedes sustained equity compression. The 40-year bond bull market ended when the 10-year bottomed at 0.5% in mid-2020. We are now in a confirmed structurally higher rate territory, not a temporary spike. For our QQQ long put leap position, this is exactly the macro environment that justifies the thesis. Long duration equity valuations are mechanically compressed by higher discount rates. The Nasdaq and growth techs are directly exposed. Our break even of approximately $531.50 remains very much in play. Fisher Black's 1986 Noise paper demonstrated that rational institutional actors must respond to yield threshold breaches regardless of their own fundamental views. Their risk management infrastructure compels it. Some of you might be aware, Fisher Black and Scholes, the options pricing volatility model. Hormuz divergence model confirmed. This slide validates the central thesis of Friar's Hormuz divergence model. The framework we constructed months ago, positing that US-Iran conflict and Strait of Hormuz disruption creates structural mispricing across energy, agriculture, precious metals, and Asia-Pacific equities. The IEA's assessment last week is damning. Crude and fuel flows through Hormuz dropped by approximately 4 million barrels per day in March and April. The global oil market could remain materially undersupplied through October 26, even if the conflict is resolved in the next few weeks. That is not a short-term trade, that is a structural condition. WTI and Brent at current prices, both above our model's baseline assumptions for this phase of disruption. Brent is was up approximately 8% last week. The market is repricing the length of the disruption, not just its existence. About time. Goldman Sachs has revised Brent forecast to $100 plus average for 2026. The EIA peak forecast is 115 for this quarter, the second quarter, 2026. Fertilizer cascade. The Hormuz closure removes approximately 20% of global ammonia and urea capacity required for fertilizer. Our DBA bull call spread thesis is being confirmed in real time. Food price inflation is the next downstream consequence. Urea transport curtailed, natural gas prices rising, agricultural input costs compounding. To repeat yet again, you can print money, but you can't print oil, nor fertilizer, nor helium, nor bromine. Beijing summit. Strategic failure, not a setback. The language here is deliberate. A setback implies a temporary delay on a journey towards a resolution. A strategic failure means the structural conditions that generated the problem have not been addressed and may have been hardened. Trump-Xi Beijing summit produced no substantive agreements. More significantly, the Chinese statement, which warned that mishandling Taiwan could put the relationship in an extremely dangerous situation, was the most hawkish framing from Beijing in years. Xi did not come to Beijing to negotiate. He came to establish parameters. China's strategic leverage. Beijing is Iran's largest trade partner and the top buyer of Iranian oil. The longer Hormuz stays closed, the stronger China's negotiating position on every other issue: trade, Taiwan, rare earths, semiconductors. The Hormuz relief valve, any meaningful US-China cooperation on reopening the strait, was the one near-term pathway to oil price relief. That pathway has now narrowed materially. Back Friar's Peter and the Wolf theory. Our analytical framework repeated false ceasefire signals, the Hormuz near-deal rally of approximately 8% earlier in the week, have degraded the credibility of positive headlines. The algorithmic models follow. The bots were briefly long on optimism. They are now unwinding the confirmation of failure. And note, with this false information that's being put out is by Axios. Beware information about the war or Trump from Axios. It's misleading, it's fake. Geopolitical risk premium. When the two largest economies in the world failed to agree on the most important economic choke point on the planet, uncertainty premiums widen across all risk assets. For our Palantir bear thesis, this is the macro backdrop that compresses high multiple speculative technology. Risk-off environments reduce institutional tolerance for duration inequity. Palantir trades on narrative and multiple expansion. Both are now headwinds. Friar continues to await the diamond signal before entering the bull call spread. Now, the question Friar has been rabbiting on about for months: how the institutional algos make their decisions. This is the question Friar posed to himself when he saw the 3 data points converge last Friday. His answer, and he stands by it, is yes, almost certainly, because the algo mechanism is not discretionary, it's parametric. It's in black and white. Quantitative macro models, whether at BlackRock, Citadel, Renaissance, or the systematic desks at the major investment banks, use multi-factor risk frameworks. When yields breach thresholds, when commodity cost spikes above the model's assumptions, and when geopolitical risk indices move adversely, the models trigger position reduction automatically. The portfolio managers do not need to make a decision. The infrastructure makes it for them. And in fact, they are not allowed to override because of risk management rules within their institutions. This is what Brunnemeyer and Pedersen demonstrated empirically. In their framework, margin requirements and funding constraints create a feedback loop. Rising volatility reduces funding availability and forces deleveraging, which increases volatility. The 3 shocks we have identified are exactly the type of correlated external shocks that initiate this mechanism. Signal 1, 30-year yield greater than 5.1%. Thus, discount rate spike, future earning streams worth less, algorithm models reduce growth equity exposure. Signal 2, WTI greater than 105, Brent greater than 108. As mentioned, as of this morning, they were already up $3 each, causing cost push inflation. Margin compression across cyclical stocks. Models reduce broad equity exposure. Signal 3, Beijing talks failed. Geopolitical risk premium rises. Uncertainty premium widens. Models reduce overall risk on exposure. Fisher-Black's 1986 academic paper remains as relevant as ever. Noise traders react to perceived signals, but rational institutional actors must respond to the parametric breaches regardless of their own views. Highly important point. When the three thresholds breach simultaneously, the institutional response is not a choice, it's a protocol. Friar believes the bots will flip bearish. However, our task is not to front run them impulsively. Our task is to be positioned when Friar's algo confirms and to trust the signal when it fires. Okay, an update on the current thesis and Friar's active positions. This slide reviews Friar's live book against the new macro environment. The assessment is position by position, not a general market view, but a specific evaluation of whether each structure's underlying thesis has been confirmed, invalidated, or remains pending. We start with the QQQ long put leap. January 27, $560 strike, confirmed. The Walsh appointment, the yield surge, the Hormuz energy shock constituent, exactly the macro conditions that justify sustained long-duration equity bear thesis. Break even, approximately $531, no action required, hold. USO bull call spread, June 26, hold. The Hormuz thesis is fully intact and deepening. IEA confirmed structural undersupply through October, so we'll let the position run to the 50% profit close target. We're not going to second guess it this time. DBA bull call spread, October 26, wait for the diamond signal. The fertilizer cascade thesis has been validated. Hormuz removes ammonia and urea transport capacity. Food price inflation is obviously next. 21-day roll trigger approximately the 25th of September, and we may roll until January 2027. Palantir bear call thesis, we discussed earlier, we're waiting. The SILV, the four leaps, coal leaps at 59, we're going to hold. Gold revaluation thesis intact. July 4th, 2026 Besant announcement remains in view. I'll do a video on that later. It's expected, well, quite possibly, that on July 4th, Besant will announce a revaluation of gold so that the US gold holdings substantially increase in value to help Trump into the midterms. The key discipline here is we're not going to add new positions on the basis of this macro analysis only. The macro provides the thesis. Friar's algo provides the entry. The doctrine is explicit on this. Okay, to wrap up, patience is the edge. Because the greatest risk in an environment like this one is not being wrong about the macro, the greatest risk is acting correctly on the macro, but incorrectly on the entry. News-driven trading is the enemy of structured option strategy. And I've put the bibliography of what I used is there for you to look at. Happy trading, happy day.